Welcome back. You're watching CNBC TV18. We're talking about results, and we just got results from FMCG major Hindustan Unilever. A look through at the numbers, and they are extremely weak. We have probably the biggest volume decline that we're staring at, a 7% decline in the quarter that went by. More importantly, Q1 is likely to be even worse because there'll be a bigger impact of the lockdown. Will be interesting to see how the other FMCG players play out as well. 7% volume decline is weaker than any estimate on the street. The weakest or the lowest that we had was about a -4% in terms of volume decline. Let me run you through the numbers. The domestic revenue has declined by about 7.5%. The EBITDA has declined by about 9.5%, and we've seen a net profit growth of just about 3.7%. The street was working with a growth of almost 17%. So across all parameters, the numbers seem to be a bit of a miss. Remember, over the last 1 week, we've seen the stock be a little more jittery, was down by almost 4% in the week that went by. Let's see whether, how the stock reacts on Monday. My sense is it would take a sharp knock. Home care revenue down 4.3%, personal care revenue down 12.7%, food business down 6.7%. Going forward, of course, for HUL, the big triggers would be GSK consolidation, and the near-term overhang would be on the supply of GSK shares that they have on HUL. The stock trading around 60 times, not particularly cheap, with no visibility of growth for the next couple of quarters. These results look weak. We have Prakash Diwan joining us on the phone line. Prakash, the street was expecting weak numbers. They're weaker than weak expectations, and we're staring at a lost quarter even in Q1. Does it mean that this could be a lost year? And then what does that mean for the stock?
Oh, absolutely. So, two things that this stock went into numbers with in terms of positioning. First is that we kind of, by virtue of timing, we just had the GSK stock that kind of got added to the paid-up capital and because of the merger, and this overhang of GSK wanting to come and sell it as a block, right? So that was one thing that kind of was putting a little bit of a lid on the stock. The second is these numbers, which was for a quarter that just had probably the last few days of a lockdown impact or some sort of a pandemic-related issue. There is the actual hit that the company would take would be now when the production is going to be difficult. All the inventory that they have in the warehouses and stock is all kind of go out and get sold out. There's nothing much they can do to produce and supply new ones. And on top of that, the consumption demand will only at best going to remain as it was. So for them to have anything which is positive volume growth for the whole year, that is, I will be surprised. And in that context, you need to look at that HUL today is almost like 60% of Unilever's global market cap. Does it warrant this kind of a valuation? And as you said, starkly no. So that's where people will have to look at. Because, the margins could probably have got away with some sort of stability because of benign input costs. But that can also not remain so forever. The next 2 quarters are going to be very challenging. Lack of volume growth, lack of pricing, and then the fixed costs will always keep on bringing things to a little bit of a difficult situation. So you will not be able to justify forward-looking earnings even after the next 2 quarters, assuming things. And remember, this product segment is not something where you have a catch-up. If people are not using personal care stuff in this lockdown, it doesn't mean that you're going to be using it when things open up, right? I mean, that time is gone, the usage has disappeared, and it doesn't play catch-up. So you will have to kind of live with that drop in volume and make it difficult to justify the 59 times P. It's really a bit of a difficult situation.
Absolutely, 60 times P, and like you said, there is no catch-up out here, Prakash, because the management themselves said that they foresee demand patterns to change going forward. They're likely to see an upswing in categories like health, hygiene and nutrition, acceptable, understandable, but in the near term, they will also see some adverse impact on discretionary categories and the out-of-home channel. Remember, across categories, we've seen a decline, while food and maybe some sort of personal care, hygiene would have seen some sort of pantry stocking. it has been a lost summer for the ice cream business as well. So, it's been a tough quarter and looks like another tough quarter. We also have Abneesh Roy with us. Abneesh, 7% volume decline. I believe you were working with a 3 to 4% decline, the lowest on the street. It has disappointed your expectations as well, as far as your preview was concerned. What do you make of these numbers?
Yes, ours was 4% based by expectation. We are lowest on the street. Once the Godrej consumer preview came, we did expect that yes, numbers could miss because Godrej consumer highlighted and the inventory uploading definitely happens for soaps. And soaps, if you see March, April is a very key month. So this is unfortunate COVID timing for soaps business. And yes, ice cream and beauty business will obviously be impacted. But this will impact almost all the FMCG companies except maybe Nestle. Nestle, I think, will outperform with around 5-6% easily growth in India, while all other non-food companies will see more of the impact of COVID. So yes, these are extraordinary times, not just for FMCG, not just for HUL, for the entire country and the world. So definitely investors will take that into account. How do I see the stock in the near term? There could be some more correction because the valuation is not exactly cheap, and there could be tougher times in April because April has been 1 month of lockdown. Yes, factories are now coming upstream, so that does mean that May and June should be far better than utilization. But near term, there could be some correction, and that is the right time to buy because I definitely expect HUL and all number one player in each category to gain market share. Gross margin, if you see this quarter also, worst quarter ever, they have seen a gross margin expansion, and Q1 there shouldn't be any problem on that. So we remain quite positive on any downtake. This is one of the best stocks to own in the consumption space.
All right. Abneesh, you said that this could reflect across the FMCG industry right now. The stocks are virtually at record highs. We've seen big bounces from lows, and valuation wise as well. HUL currently trading at what, 60 times, 59, 60 times. For all the other stocks that there are, do you think there could be a case for multiple derating as far as the valuations are concerned?
Near term, some could happen, but the important thing is now people start factoring in what happens in the recovery because now lockdown, most of the lockdown phase is behind us. Factories are now almost all the key factories are up and running. Capacity utilization is still not 100% because of manpower availability, but worst is behind on that aspect. So I do not see any structural derating because most other sectors will see much bigger decline, and this decline in HUL volumes is not at all because of demand. This is completely corona-led, and once COVID lockdown ends and factories are again back, I would expect some pent-up demand also for some of the segments, definitely in the foods and in the hygiene. Those will definitely happen because inventory levels are running very low. If you check any e-commerce website, if you check any kirana, a lot of the stock out for HUL and every company is there. So that pent-up demand will definitely be helping when the lockdown ends and the supply definitely comes in place. So I am not unduly worried. What are the stocks to buy? HUL, Dabur, Nestle, Britannia. These are the four companies which will gain market share. They are the strong leaders. And they'll also gain, part of the portfolio will gain because of the corona-related changes. The personal care for HUL will be challenged, but rest of the portfolio like hygiene and definitely foods, that will definitely work well. GSK portfolio obviously now adds more muscle to the entire food portfolio.
Abneesh, last question before we let you go. You said that this is supply-related decline in terms of volumes, but in the second half, do you think because of coronavirus and the impact that it will have on the economy, there could be some demand-related challenges as well, more so in terms of down trading of products, and that would cap the sort of growth that we would see in earnings?
What happened in 2008 GST. So even in that year, you see most FMCG companies did see reasonable volume growth. Yes, GDP correlation is definitely there. But whenever crisis happens, the smaller players lose market share because they will not be able to manage all this uncertainty in terms of the dollar, in terms of the approvals, in terms of factory and manpower. If it is the bigger companies have got that approval, the smaller companies are not getting it easily because authorities also know that the compliance for smaller companies will be very difficult really to ensure. So I would expect that for HUL and the larger companies, volume growth in second half definitely will come. This will not be no growth. Even in the GFC crisis, we did see growth happening for most of the FMCG companies.
All right, Abneesh, thanks a lot for joining us. The next couple of quarters could be challenging, but growth will return, and for organized bigger players, it would return faster than the others. Prakash, your final word on the numbers. They are weak. The next couple of quarters look like they're going to be weak, but do you think investors are going to give a longer rope to the FMCG sector as they have in the past, and the stock, any sort of dip, would be bought into? All right, I think we've lost Prakash. Before we try to repatch with him, just a word again on the numbers.
Can you hear me? Can you hear me now?
Yep, we can hear you, Prakash. So I was saying that,
I heard you.
Yep, go ahead.
Yeah, so I'm saying, looks difficult to believe that these stocks will not be on the shopping list for most large investors because, they continue to offer great quality businesses, very strong balance sheets, and secular, demand trends in the long term. You don't expect the HUL not to be around after, let's say, 2 years, right? Even if the pandemic keeps on kind of disrupting things. What could happen is, there could be a dosage of realism that comes in with the valuations. And my sense is if the stock reacts to negative numbers and muted expectations going ahead, and let's say comes to sub 2000 levels, that would be a great time to buy it and then build it into your portfolio, because then you are kind of buying it at a price where you are more insulated. So I think the business is resilient, and I do agree with Abneesh when he says that the organized players will only become stronger. They will be having market share gains, but you need to understand the fact that there could be a protracted period of time where these companies might not deliver great growth. So for, let's say, 1 year there is zero volume growth. Are you willing to buy it on FY22 basis? And if yes, at what valuations is what you need to answer. And to that, my question is anywhere around that 1700 to 2000 zone is a great viable zone.
All right, Prakash, thanks a lot for stopping by and giving us your view on HUL. So that's about HUL. This would go down as a weak quarter for the FMCG major and gives a lot of inkling into what the other consumer companies are likely to do as well. With one set of weak numbers, we take a short break, come back, analyze another set of weak numbers, that is Tech Mahindra.